Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. Now, before we get started with today's video, I just want to quickly say, if I'm silent, I'm probably busy working on the next big thing. I realize the very big portion of you are intraday traders. So over the past few weeks, I have been a lot more active on the intraday scene to bring more intraday trading content for you all. So it goes without saying, make sure to turn on the post notifications below to be the first to get notified about future intraday videos. Now in today's video, I want to cover some unbelievably crucial information and certain do's and don'ts when it comes to practicing trading or backtesting, in other words, simply because I've realized even the people who think they know how to backtest effectively and how to backtest properly still make very common mistakes within their backtesting journey, which later on will actually impact their live trading. So regardless of what point you are within your trading journey, it's important to address these issues, and it's also crucial to speak about the correct ways that you can practice and backtest. So if you get value from the video, don't forget to press the like button down below. But with that being said, let's first speak about the actual mistakes a lot of people make when it comes to practicing or backtesting trading. Later on in this video, we'll actually do some chart analysis as well and chart examples on exactly how you can backtest. But speaking about the mistakes at the very beginning is crucial. One of the most common practices when it comes to backtesting is when people only look for where they would have actually entered the trade. Now, just because it's a common thing to do doesn't necessarily mean it's a correct thing to do. For example, something that I have seen some traders do is ignore some extremely crucial information on the charts and simply just go based on whatever suits them. By that I mean they might be able to identify a scenario like this, yet all they care about is this mitigation of an institutional candle over there, thinking that yes, this is going to be a trade that's going to go to the downside, meaning when they're backtesting and looking back on the charts, they would think to themselves that this would be the type of trade that they'll end up taking, simply because that was a mitigation of a previous institutional candle. Whereas in reality, the other important information on the charts is actually being ignored. For example, the fact that this is in a bullish trend. So if you were seeing this live, you wouldn't have necessarily gone for a sell position. Now I'll elaborate on that a little bit further on later. But this is a very common practice that people do, which in my personal opinion doesn't actually necessarily help. Because when you're backtesting, it's not necessarily about where would I have entered. It's more so about understanding market behavior. And when you look at the charts, actively looking for exactly where you would have entered, you are constantly ignoring crucial market behavior information. And this leads me to the next point. A lot of people, when they backtest, they ignore losing scenarios. So for example, when they are looking back on the charts, they would only look for scenarios that have won. They would only care about the institutional candles that did get mitigated, or the Wyckoff schematics that did work to perfection. Whereas when it comes to those schematics or patterns that are a little bit more difficult to identify, or when it comes to certain candles that never got mitigated, or any and every scenario that on a live chart you would have actually lost, all of these scenarios are actually being ignored. People actively only look for scenarios that have won, which means when you consistently do that for a few days, weeks, or months, whenever you decide to trade on the live account and trade the actual live charts, you are not going to have a good time because you are not used to seeing those losing scenarios. You're just used to seeing scenarios that have played out. You haven't learned how the market actually behaves. You've more so learned certain random candles or random schematics are just getting respected, and based on that you might have thought that that's it. You've gotten your head around the concept. So acknowledging losing scenarios is also important. Those would be the scenarios that you'd be able to learn more from because it challenges you to think a little bit deeper about how comes that specific scenario didn't actually play out. Another very common mistake when backtesting is people ignoring their emotions, ignoring their trade management rules, their set of rules, etc, etc, etc. Naturally, when you're analyzing the live charts and about to execute trades on your live account, you are going to make emotional based decisions unless you've worked on your trading psychology. But when it comes to backtesting, there's no emotions because you're going back in the charts, you're seeing stuff that's already happened, and you ignore those emotions that in reality, when you were trading live, they might have actually affected your judgment. In other words, a lot of people who backtest do not actually treat it as if it was live. And that's going to be one of the most important things that you have to do when it comes to your own backtesting. Whenever you're analyzing the charts, you have to treat it as if it was live, meaning you have to consider your emotions, you have to consider your trade management rules, you have to consider your trade execution rules, you have to take into account even time of day, day of week, these type of factors that would actually affect your normal trading. So if you're backtesting, don't be the type of person that just goes back on the charts trying to figure out what scenarios have played out, and after only finding finding a few scenarios that have gone the right way, you end up thinking that that's it, that concept or strategy definitely works, and you're ready to go live with it. But now that we have spoken about the mistakes traders make, it's important to understand there are a few different ways to backtest, one of which is when you do it without the bar replay button on TradingView. In other words, when you don't stop yourself from seeing the future candles in the specific area that you are backtesting. So this is simply going on your charts and maybe scrolling back as much as you can, but not necessarily stopping yourself from seeing what's happened after the area that you're looking at. Yet you want to analyze market behavior, you want to analyze exactly how the market has moved to get yourself more used to seeing market behavior. It's important to understand the aim of why you are backtesting, and in my personal opinion, backtesting in this style is simply to get your eyes used to seeing different things, such as those institutional candles or the mitigation of the institutional candles, such as those manipulations of the trend lines, of the support zones or resistance zones, or the Wyckoff schematics, the areas of consolidation that have resulted in an impulsive move, or as mentioned before, generally the market behavior. The point of backtesting, the point of getting your eyes used to seeing how the market moves, is for you to be able to identify the story and for you to be able to follow it. And what I mean by the story is whenever you look at the trade breakdowns that I'm posting on this channel and will continue to post on this channel, it's always a series of events that have led to one trade execution. In a way, it's the market telling me a story from a supply and demand perspective that have resulted in me being confident enough to being able to execute that trade. So one of the points of getting your eyes used to seeing how the market moves is being able to identify the story, asking yourself questions such as why it has reacted off of that candle, why it has moved away from that zone of consolidation, why did it break a structure point, what happened after it broke the structure point, why did it manipulate a certain area, and which direction did it move after. These are the important things to take into consideration when you want to backtest. You are here to become a full-time trader, and a full-time trader is someone who's able to identify the storyline very easily. Now, last but not least, define your set of rules. The truth is, if you don't know how to systematically approach the charts, you wouldn't even know how to backtest properly. You'd just end up going back on the charts and being still very confused as to where to start. So you have to have your set of rules. You have to know, for example, what time of day you want to trade, what session you want to trade in, whether you want to be a shorter term trader or a longer term trader, which would relate to the time frames that you would mostly end up looking at. What do you base your trades on based on your specific strategy? Let's say if you're trading smart money concepts, what's your first step of analysis? If you don't know the answer to these questions, backtesting is going to be extremely difficult. Hopefully watching some of the trade breakdowns that I have on this channel, or the market structure series, or even the top-down analysis videos that I have would give you more of a clear direction as to how you can actually formulate your own set of rules. Backtesting this way should not be difficult. Remember that the aim is to get your eyes used to seeing market behavior. So let's say you want to backtest things like Wyckoff. One of the easiest things to do is to look at areas of consolidation in the charts, areas that the market has gone sideways, yet you can see a reversal take place straight after that zone or some type of a continuation after that zone. The bottom line is, for Wyckoff distribution, it's quite easy to do it because mostly you'd be looking at the top of the range and trying to find those areas of consolidation and then going to lower time frames if need be, comparing it to the schematics, comparing it to the market behavior behind Wyckoff schematics, and then see if you can mark it up for yourself. When it comes to accumulation, it's going to be vice versa. You're looking at areas of consolidation, more so at the bottom of the range, and how it's actually worked out within those regions. Whether the market has ended up leaving that range for good or coming back to maybe manipulate that range or respect that range, these are the type of things that you really want to be asking yourself. When it comes to reaccumulations, as you can imagine, you're simply looking at areas where you've had a rally in a given direction, you have a sideways move, and you see a continuation of that rally. As an example, this would be a reaccumulation over here where you've had the rally, you've had the sideways move, and you can see the continuation after, and vice versa for redistribution, an example that we highlighted here earlier, where you can see a drop, you can see a sideways move and a continuation drop of that. This is now an effective way to backtest Wyckoff, because first you're looking at those areas of consolidation at the correct places in the charts, then you're going to the lower time frames and seeing if that's a valid schematic, seeing where it broke structure, seeing what happened after it broke the structure. etc, etc, etc. You can little by little start to mix these schematics with areas of manipulation. So maybe you want to start to look at exactly where the market has been manipulated, what's happened at that area of manipulation on the lower time frames, and see if adding these two together is going to formulate the story that we spoke about a little bit better. Ooh, we've had a manipulation of the highs and we've had a Wyckoff distribution. So that's now a more likely scenario for it to actually continue in that given direction. Don't get too lost on which time frame you want to look at, but you can switch between time frames as well to get a better idea of different stuff that you can see. For example, over here on the hourly time frame, you might be able to see some type of a move to the upside, straight reversal from there, and a pullback to the same area. Now, this doesn't necessarily look like a clean institutional candle on the 1 hour time frame, but looking at the same thing on the 4 hour time frame, you would be able to see a much clearer mitigation of that institutional candle. In this case, you can even see the mitigation of the one before as well, much clearer. This is now you getting your eyes used to seeing these concepts first, and then once you get better at identifying them, asking yourself the questions as to why they have or haven't been respected, and seeing if you can start to formulate that story from here. But all of that to one side, now let's get into what I consider one of the most effective ways to practice trading. This is where you don't know what is going to happen in the next candles, which is either because you're using the bar replay button, which is right over here, or maybe you are forward testing. In other words, you're paper trading, you're actually analyzing the live charts, marking up your entry, stop loss, take profits, not necessarily executing the trades or only doing it on demo, but mostly caring about whether or not your trading scenarios have gone the right way. If so, amazing, and if not, why? So like before, firstly, defining your set of rules is yet again going to be one of the most important things to do here. Otherwise, you will just end up putting this in replay mode without necessarily even knowing exactly what to do, exactly how to analyze the charts. If you have got access to the bar replay button, then amazing, you'd be able to use it on the lower time frames. If not, I would recommend you to just do paper trading, or if you want to utilize this style of back testing, what you can do is you can simply scroll back on the charts and use this end bit as your bar replay button. So in a way, you don't let yourself scroll past a certain area, a certain candle. You might even want to, for example, put yourself a vertical line here and say, you know what, I'm not going to scroll past that. You analyze everything before that, and little by little just scroll to see if you were correct or wrong within your analysis. For those of you who are going to be using the bar replay button, I'd recommend you to go on the lower time frames and then scroll back to put it in replay mode, simply because if you go on the daily, weekly or monthly and scroll back and put it in replay mode, because the data you're looking at is going to be from years ago, you most likely wouldn't have access to the lower time frames. But if I go on the 15-minute or 10-minute or 5-minute charts and just scroll as far back as I possibly can, look away and quickly put it in replay mode, you would have a higher chance of being able to analyze lower time frames as well, and you most definitely would be able to look at higher time frames around the same area as well. Once you have your set of rules defined, it's going to be much easier for you to actually start to analyze the charts. So let's say you've put it in replay mode, you're looking at different time frames, and for example in this specific case, you're able to identify that, oh, hang on a second, this kind of looks like a big manipulation of the highs. Wherever you end up drawing those equal highs, it seems as though this huge rally to the upside started to manipulate the highs. It looked like a break of structure as well. However, we ended up getting a pullback all the way to the downside and also starting to create downside liquidity right over there. So it kind of makes it likely, after the manipulation of the highs and multiple redistributions in the range as well, for this to actually start to be going back down. So based on whatever you see, you formulate your bias, you end up looking at different time frames to see if your bias is still being consistent. So let's say you started to now look at this on the hourly time frame and started to think to yourself, oh, hang on a second, this actually kind of looks like an accumulation schematic and kind of looks like it started to break that structure point to the upside. So perhaps we can also look at buy positions over here. Being honest is really important. Treat it as if it's live. Now you have two directional bias. You think it's going to go down to manipulate those lows, but you also think it could have just accumulated over here to then create a new high. Chances are, if you were seeing this live, you wouldn't have actually executed a trade unless it was for fear of missing out. If I was seeing this live, I would wait. I would have patience. I would want to see where is this more likely to actually start to break. I would start to pay closer attention to what has started to take place in specific areas to cause such reversals. But either way, I would be honest with myself and I'd say normally I would wait. And once I wait, once I have that patience, I'd simply want to wait and see, okay, look, we have gone to the downside finally. And this market going to the downside looks quite clean, looks quite well taken care of, in the sense that it doesn't look like it was just a manipulation of the lows for it to then start to reverse. It's as if it's telling us supply is in power. Let's say now you're looking at this, looking at your potential sell scenarios, and you have multiple levels that look really good to you. Maybe you can see that over here you've got an institutional candle in the middle of the range, so perhaps that's one of the levels that you want to focus on. Or maybe you trade slightly differently. Maybe you want to trade break and retest scenarios or trade based on other drop-based drop formations. So you go ahead and identify this level also as an important level for you to take trades based on. Once you go ahead and formulate your bias, be real with your entries and your stop losses. So let's say you decided to put your entry at the open price of this candle with your stop losses at the high. The question is, would you actually now be taking this type of scenario if this was your live account? Let's say targeting down here or below as well. Would you actually execute a 38 pip stop loss? It depends on you. It depends on your trading style and your trading strategy. Sometimes 30, 40 pip stop losses is a very good stop loss for people. So what I'm trying to show you here is constantly asking yourself, what would I do if I was seeing this live? That would eliminate all of the wrong things that people do when it comes to backtesting. And the rest of it is just letting it play out, following what the market tells you. From time to time, I'd like to pause it and maybe reanalyze it and see if I've missed anything. Okay, you know, we didn't come up there. Is that level still valid? Is that now a level that I can still trust? I need to look at the higher time frames for me to look at the validity of that specific level. So far, that level still looks good. That final push to the downside was to finally go below these lows. So knowing market behavior, it isn't unlikely for it to pull back up to those levels before dropping. But again, it's about being honest with yourself. So maybe if you were seeing this live, you would have considered that level still as a sell entry, but you would have also looked at this candle over here. You would have also wanted to take a trade based on this candle. Now you have two levels. These are the type of scenarios that would actually confuse people when they are trading live. But when you're seeing it in a backtesting format, it's going to be much easier for you to be able to identify why it reacted off a certain level and not the other one. Again, now you've got your point of interest, you would want to wait and see what the market does. Now that it's within that point of interest and getting ready for those potential first sells, again, you want to ask yourself, what would I have done if I was seeing this live? Where would my exact entry and stop loss be? Maybe it would be at the open price of the candle with stop losses being just above the wick. A lot of the times when you're trading live, you can actually end up getting slightly different entries and stop losses to when you're backtesting because you're affected by your emotions. Because maybe you would see this sharp drop over here and your entries is slightly higher, and you'll end up just selling it by market down here just to not miss out on the trade. You have to be honest. You also have to consider your emotions as well. For example, let's say you've gone ahead and taken this trade and now little by little is still floating in loss. Candle after candle is maybe going a little bit deeper into the loss as well. It's important to ask yourself whether or not you would have actually kept this open if you were seeing this live. It's important to also look at the time of day. For example, this trade started to come to entry around 5-6 p.m. UK time. That's after London close. Now the question is whether or not that actually agrees with your set of rules, because if it doesn't, this entry is immediately invalidated. Think about all of the factors that would impact your judgment if you were seeing the setup live. So that's emotions, entries, stop losses, trade management in terms of where would you have closed it, where would you have broken it even, whether or not you would even stay in a trade like this, etc, etc, etc. And the rest of it, I recommend you to go candle by candle once it comes to your entry to allow yourself time, even maybe go on the lower time frames, to allow yourself time to truly answer the question whether or not you would have stayed in this trade. Perhaps in this scenario, you might want to be honest with yourself and say, do you know what? If you were seeing this live, you would have actually still stayed in the trade, thinking it's probably going to mitigate that final institutional candle over there. So maybe you would have actually endured this drawdown if you were seeing it live. That's not a short period of time either. That is around 8 hours of price that we are talking about. So again, the question is, would you have actually stayed in this trade, seeing it in drawdown for 8 hours? And little by little, just let it play out. Watch how it moves. And again, keep asking yourself the question, what would I do if I saw this live? Because chances are, if I saw this move as I was trading this live, I would have started to close my positions. Yes, it can very well start to react off of levels over here and drop, but chances are it's going to pierce through it, especially because now that's around Asian session as well. So that's definitely not the times that I would be looking to trade. So I'm going to be honest with myself and say, if I was trading this live, that that would have been a one stop loss scenario. I would have gotten out of the trades probably earlier than it would have hit stop loss, or maybe it would have been a complete stop loss trade. And once you have that final decision, journal it. Journaling is very, very, very important. I'm going to give a few tips on journaling a little bit later on as well. The rest of it is just letting it play out. So maybe that's around now 2:30 a.m. UK time, and that's not around the times that you trade. So perhaps you want to wait. You wait until we start to approach the London session. Now that's London Open. You would want to start to analyze it again. Now you remind yourself that, I have another entry up here as well. So perhaps you might want to wait until it even approaches that entry and then ask yourself the question as to what would you have done around these levels. Let me put it a little bit more in replay mode before we approach it. So again, you want to do the same thing as it comes to your other entries as well. Once it starts to reject your entry, you ask yourself the question as to what time of day is it? Okay, that's around 9 a.m. That's 1 hour after London Open. So that's the prime time that normally a lot of markets can start to actually move. So that would be a time that I would comfortably be executing trades on. So this trade in terms of time of day is now valid. But the question is, if I saw this impulsive move into my point of entry, would I have actually taken the trade? Even if this trade ends up going in people's direction, one thing that traders would actually end up doing, they most definitely would have taken the trade just because they had the entry and the stop loss in place, but they wouldn't care about everything that took place after. The reality is, seeing such an impulsive move into my point of interest probably would actually throw me off from wanting to take this trade. Perhaps after seeing this move to the downside, I would have then looked at my entries, looked at potential areas where I can take the trade. Or let's say you tell yourself that you would have definitely taken the trade there because it was the right time of day and this impulsive move wouldn't throw you off. The question is, after it went down here, would you have broken it even? And if so, would this move back up taking you out at break even or not? It's important to also be real about the emotions. Chances are, if you were looking at this live, you would have been very, very happy to see it go in your desired direction, but seeing it pull back up for a good few hours as well, chances are would throw you off. It would make you want to exit the trade. So it's also important to be real in terms of the emotions and journal those as well. And from there on, just let the market play, let the chart do its thing and analyze as the market is moving, as the market is doing its thing, formulate your bias. You might not necessarily even want to worry about your entries and stop losses at the very beginning. You might just want to identify general direction. So you might want to forget about these entries and stop losses. First, you want to get good at identifying direction and then little by little getting into the entries and stop losses and then the lower time frame confirmations. Based on everything that I just said right now, I hope you've taken the most important thing that I've repeated about 20 times as I was explaining as well. Honesty. Treat it as if it was live. You have to consider your emotions. You have to consider trade management. You have to consider time of day. You have to consider your set of rules. Without them, backtesting is pointless. And as I mentioned earlier, journaling is also extremely important. This is more so for forward testing, and by that I mean paper trading or when you're analyzing the live charts, formulating your bias. Now, this isn't a trade that I'm looking at, but as a random scenario, let's say you're looking at that institutional candle over there with stop losses at the high and you want to take it low. Again, I want to re-emphasize that this is not a trade that I'm actually looking at, but let's say this is the type of scenario that you're looking at. Journaling is going to make all the difference, and journaling is easier than ever done before because all you need to do is create a Telegram group chat with yourself or create a group chat with one of your friends and then kick them out of that chat and then use that chat to journal your trades. All you have to do is take a trading view screenshot. This will literally tell you everything about your setup. Once you visit that link that is sent you, not only you would be able to see all of the chart analysis that you have done, you would also be able to see the pair, the time frame, the date, and the time that you've actually taken the screenshot as well, which means all of the crucial information about journaling is already there. All you have to do now is take that link, paste it in that Telegram group chat with yourself, and then just document it. As simple as that. You might want to paste the link with a quick description as to Euro AUD, and this is the short scenario for it. Once this trade plays out, let's say, in the next few days, this either goes and hits stop loss or it comes and hits take profit. Either way, you want to update your journaling. So you want to take another screenshot like this, copy that, you want to go to your Telegram, or reply to the message that was the first documentation of this trade, paste the link and send it again. That chat would turn into an ocean of documented trades. If you want to be a little bit more organized with it, make a group chat once every month. So have one for your January documentation, one for your February, one for the March, April, May, so on and so forth. But believe me when I say this is the journey that any and every successful trader has gone through. So if you're trying to duplicate their results, you have to duplicate their pain, you have to duplicate their journey as well. By that I mean just because you may know how to backtest properly now, this doesn't mean you would automatically reach insane consistency. This wouldn't mean that you'll automatically hit take profit after take profit. And it also doesn't mean that over the next few days or couple weeks you're going to become a full-time trader. It's a journey. It takes time. Endure the pain of process and grow. A lot of your entries will hit stop loss when you're backtesting or when you've started to forward test. A lot of them. It's okay. We have been there too. But that's the journey. That's the entire learning process. And I want to wrap it up by proving to you, you have been through journeys like this in the past and you will be able to go through this journey as well. Chances are throughout your life you have learned a lot of different skills, but the same way you might find it difficult right now to get consistent with trading, you must have found it difficult at the very beginning stages of whatever skill set you were learning. Whether it was speaking in a new language, maybe you play an instrument and you can relate to it from that perspective. Perhaps you do a sport and at the very beginning you weren't really good at it, but over time that skill set got better. Whatever it may be, think of different skill sets that you have developed throughout your life, and chances are there was an entire process that led to you having the type of consistency that you would want to have with that skill set. What I'm trying to say is you've been through the journey before. With entrepreneurship, it's going to be the same. Sometimes it can be a little bit more challenging as the outcome you're aiming for a lot of the times is going to be much greater as well. But it's the same thing. It's the same journey of learning a skill set. It's going to start difficult. It's going to be confusing. It's not going to make sense. It's going to be annoying. It's going to be frustrating. You're going to get angry. But over time, it gets better. And over time, you get more consistent as long as you're also consistent with your learning. Remember, patience, both in your learning and in your earning. But with that being said, if you got value from the video, do make sure to press the like button down below and subscribe to the channel if you're new, and turn on the post notifications to be informed about the future intraday content and perhaps some more detail about supply and demand in the next few weeks and months. Hope this video cleared some things up in terms of how you backtest effectively. Make sure to utilize them, make sure to apply them. So let's elevate and let's catch some pips.